Did you know there are cities in California where just buying a home means losing hundreds of thousands of dollars in just a few years? A place once seen as an Airbnb paradise. Now the city has completely banned rentals. A place once fought over by tech buyers. Now prices are plunging and people are fleeing. And you're still wondering, is now the right time to buy? I'm going to show you 10 cities where the bubble is quietly bursting, with data, proof, and things realtors will never tell you. Watch until the end, and you'll know whether to stay, leave, or at the very least, avoid becoming the next victim. Talk to 10. San Francisco. When trust shakes in the tech capital. San Francisco was once the stage for the most expensive version of the American dream. But today, the very city that minted million-dollar fortunes from tech stocks is watching that dream crumble. Right on the concrete foundations of its once iconic towers. After the pandemic, San Francisco's housing market entered a sharp correction. By the end of 2024, home prices here had fallen an average of 10.9% in just 1 year. The steepest drop in the entire United States. Yes, it sounds crazy, but numbers don't lie. The median single-family home price now sits at about $139 million back to 2019 levels. Condos have fared even worse, down 14.7% from their May 2022 peak. Nearly $170,000 wiped out per unit. For many, these aren't just condos. They're retirement funds or assets meant to be passed down to children. Now, hundreds of thousands of dollars have evaporated overnight. Who wouldn't be worried? What's scarier is that this isn't a short-term dip, but a long return to earth for a market once thought to be unsinkable. Why is this dangerous for middle-aged and older homeowners? Because for more than a decade, many have staked their retirement on the value of their home as a kind of hidden pension fund or a legacy for their children. Now, home prices are falling sharply, while living costs remain 18% higher than the national average. Squeezing retirement budgets from both sides, assets losing value, expenses still rising. It's not just real estate, trust in the entire city is shaking. From August 2022 to the end of 2024, the information sector, the very core of the tech industry here, lost 20% of its workforce. When tech companies laid off in waves, stocks plummeted, and bonuses disappeared, tens of thousands of households suddenly lost the financial ability to buy or even hold on to their homes. The market reflects this instability clearly. Over 18.6% of listings had to cut prices, while buyers were only willing to pay 4 to 5% below asking. Mortgage rates at 7 to 8% have driven demand down even further. Inventory is rising, transactions are stalling, and fear is spreading. In the past 5 years, San Francisco has lost more than 31,000 residents, about 3.6% of its population. In 2024 alone, another 3,300 people left, the biggest drop in the entire Bay Area. Many families are moving to other states because they feel this city no longer belongs to them. No longer friendly, no longer safe, no longer worth its exorbitant cost of living. Despite its mild climate and lack of hurricanes, San Francisco sits on the earthquake belt, a factor that makes home insurance both expensive and difficult to secure. Add in the rise of crime and homelessness after the pandemic, and the image of the Golden City is now clouded with worry. What do you think? If you were about to retire, would San Francisco still be a safe place to keep your wealth and settle down? Share your thoughts in the comments below. 9. South Lake Tahoe. When paradise becomes an illusion. There are places that were once a dream, but at some point, you have to wake up and realize you're holding nothing more than a risky illusion. South Lake Tahoe was once the emerald gem in California's pine forests, a place people flocked to during the pandemic to escape. to breathe mountain air, to buy peace of mind. Home prices soared to unimaginable levels. In North Tahoe alone, the median price jumped 178% in just 2 years, from $660,000 to $175 million. It was the era of Airbnb dreams and easy profits from vacation rentals. But by 2025, the story has flipped, and in brutal fashion. The median sale price has fallen to just $572,000, losing nearly 20% of its value in a single year. More than 1/3 of listings have had to cut prices. Transactions have slowed, and unsold homes sit idle waiting for buyers. A market once burning hot with demand now feels as cold as a deserted ski resort in midwinter. The reasons? Policy shifts. South Lake Tahoe banned Airbnb rentals in residential neighborhoods, while Placer County capped the total number allowed. Tourism weakened after the pandemic. Visitor numbers shrank. The result? Hundreds of vacation homes that can no longer be rented, no longer cover costs, no longer assets, but burdens. Up to 44% of homes in South Lake Tahoe sit vacant most of the time. A city with over 7,000 houses, nearly half of them not regularly lived in. Quiet, but not the kind of peace anyone really wants. Locals are leaving, long-term rentals have vanished, prices remain too high, and the forests are drying out and burning. Because Tahoe isn't just a place to live, it's prey for natural disasters. In 2021, the Caldor fire came dangerously close, forcing the evacuation of all visitors and leaving the region with the worst air quality in the world. Many insurance companies stopped covering homes in Tahoe, forcing new homeowners onto California's FAIR plan, where premiums can double. A $1 million home, if burned without full coverage, could lose 60–80% of its value overnight. That's the price of a dream that was never properly calculated. Amid all these risks, from the Airbnb collapse, declining tourism, high interest rates, to relentless natural disasters, trust in South Lake Tahoe is cracking. This is no longer an ideal destination for retirees or investors, but a costly lesson for anyone betting without accounting for the worst-case scenario. And you? If you had $600,000 in hand, would you dare invest in a place on the brink of burning, left vacant, and facing a looming vacancy tax from local authorities? Share your thoughts. And if this video helped you see the market more clearly, don't forget to hit like and subscribe to follow our upcoming analyses. 8. Palm Springs, where the Airbnb dream dries up under the desert sun. Once a golden destination for Airbnb investors, Palm Springs is now going through a long, dry season, not only in climate, but in confidence and profit. By June 2025, the median home price here was around $400,000, down nearly 3% in just 1 month. Inventory spiked to 754 listings, the highest in the Coachella Valley. The market has clearly shifted in favor of buyers. But strangely, buyers are hesitating too. That's because Palm Springs is no longer the Airbnb party. It was in 2022. A strict cap of 20% of homes allowed for short-term rentals has been reached, and over 100 properties are now stuck waiting for permits. Neighboring cities have banned Airbnb altogether. Investors who once thought they struck gold are now selling at a loss, retreating quietly. The once bustling buying frenzy has disappeared. In 2023, home sales fell 50% compared to peak levels. Prices haven't crashed, but they're stagnant, while insurance, taxes, and mortgage costs keep rising. This is the silent decline that drains the market without anyone noticing. Worse, the median household income is only about $55,000, while homes cost around $500,000. The price-to-income ratio is nearly 9, making it clear that locals have been priced out. And now, with out-of-town buyers exhausted by shrinking Airbnb returns, the real estate market here is slowly withering. Palm Springs is also scorched by its own sun. Temperatures above 113 degrees, 45 degrees, nearly 170 days of extreme heat each year. Droughts, dust storms, and even tropical storms have all struck. The heat doesn't just burn skin, it burns away appeal for younger buyers or anyone sensitive to climate. Palm Springs. Once hot for prices, now hot because no one dares to buy. What do you think? If you once dreamed of owning a desert vacation home, would you still dream after knowing the truth? Don't forget to comment and share your thoughts, and hit subscribe so you won't miss the next cities that are smoking out, just like Palm Springs. 7. Dublin. When beautiful homes and high incomes still feel suffocating. Dublin was once the shining gem of the East Bay, home to high-income residents, modern infrastructure, and one of the fastest urban growth rates in California. By 2022, the median home price soared to nearly $1.5 million, on par with Cupertino or Palo Alto. But from that point on, the bubble began to deflate. In just 1 year, Dublin homes lost nearly $230,000 in value, the steepest decline in the entire US. This wasn't a minor correction. It was a clear sign that the city had become far too dependent on the tech industry. Dublin has no major universities, no large-scale manufacturing. It lives off the workforce commuting to Silicon Valley and the tech headquarters in the East Bay. When layoffs swept through in 2022-2023, from Google to Meta, engineers began pulling out. Some returned to their hometowns, some relocated to cheaper states, others sold their homes to cash out at the peak. Dublin's population is still growing, but no longer made up of the top 1% earners. Rather, it's now buyers picking up discounted homes, or renters taking over from former owners. Right now, the market is losing balance. Time on market has doubled, price cuts exceed 18%, and new supply keeps flooding in from projects planned before the downturn. This makes recovery difficult, even if interest rates ease. In the long term, Dublin's strength lies in its stable living environment. No wildfires, no flooding, mild climate. A big advantage compared to many other California cities. But without diversifying its economy, Dublin risks being frozen, no longer overheated, but also no longer attractive. Would you be willing to buy into a market that looks good on the surface but is losing momentum? Or would you wait for the next wave, though no one knows whether it will be a rebound or a deeper crash? 6. Windsor. When the machine city falls into a fearful silence. Windsor was once the symbol of Canada's working class, a place where the roar of car engines filled the air day and night, where every family dreamed of a small home, a steady job, and a clear future. But the reality of 2025 looks nothing like that dream. The city once thrived on heavy industry. Now factories are shutting down one after another. Workers are losing jobs en masse, and unemployment lines grow longer by the day. No longer a bustling city, Windsor has become a place where faith in the future is chipped away bit by bit, where the silence of idle machines is replaced by the sound of sighs. Home prices, once a point of pride, have turned into a burden. From under CAD 200,000, prices skyrocketed past CAD 600,000. Locals can't keep up. Familiar homes are now in the hands of Airbnb landlords, out-of-town buyers, or simply investors holding property without living in it. Windsor doesn't lack houses. What it lacks is commitment. It lacks families willing to build a future here. Real residents are pulling out, quietly, sadly, leaving behind cold neighborhoods and homes lit but empty. At one point, the battery plant project was hailed as the spark that would revive the city. But before hope could take root, rising insurance costs, soaring utility bills, and heavy taxes once again smothered expectations in silence. To many, Windsor feels like a faded painting, once vibrant, now only gloomy and washed out. The question is no longer, will home prices fall? But, who still dares to buy here? Who has the patience to wait for Windsor's revival, while other cities beckon with opportunity, jobs, and an easier life? Windsor now stands at a crossroads. Will it return as a true symbol of recovery, or remain forever a buffer zone, forgotten between a glorious past and an empty present? Have you ever lived in Windsor? Do you still see a light at the end of the road? Share your thoughts, because your stories are what truly reveal the soul of this city. 5. Fresno, not crashing, but no longer easy to breathe. Fresno was once the escape hatch for thousands of young families, those exhausted by sky-high Bay Area prices, coming here where $300,000 could still buy a decent home. But that dream is now breaking into pieces, as Fresno is no longer the easy place it was believed to be. Home prices here once climbed as if they had no ceiling, from under $300,000 in 2018 to over $400,000 today. But behind those numbers lies a market gasping for air. More than 1/3 of homes must take price cuts to sell. Listing times are stretching out, and buyers are hesitant, waiting, unsure. Because the problem isn't just the price, it's affordability. With median incomes of only $55,000, $60,000 a year, most Fresno residents are being pushed out of their own market. Want to buy a $400K home? You'd need double that income and be ready to sacrifice over 50% of your monthly paycheck just to cover the mortgage. That's not a dream, it's a financial shackle. Fresno isn't collapsing like Airbnb-driven cities, but it's losing the appeal it once had. The market is experiencing a soft landing, but one that still leaves many people struggling. Investors who once called this the promised land are now standing back and watching. Families who once pinned their hopes on stability are now asking, how long can we really hold on? And there's another truth. Fresno's climate is getting harsher. Air quality ranks among the worst in the US. Summers suffocate at 108 degrees, 42 degrees, and the risks of wildfires and droughts hang constantly overhead. Home insurance costs rise year after year, making ownership far less friendly than the listing price suggests. Fresno isn't terrible, but it has changed, and you need to change your perspective too. This is no longer the place where buying means winning. If you're considering Fresno because you think it's the last affordable choice, think again. Does Fresno deserve the long-term risk? Or is it just a temporary stop before you continue searching for a truly livable home? Share your thoughts, because your story may be the same as thousands of others standing at this crossroads. 4. Bakersfield, where homes are still cheap, but risks keep piling up. Bakersfield was once the escape route for thousands of young families from Los Angeles, a place where you could still buy a house under $400,000, with a backyard, a 2-car garage, and the dream of homeownership. But few expected that the very idea of cheap would become a trap, leaving many stuck between fragile economics, harsh climate, and shaky insurance. Between 2019 and 2023, Bakersfield's housing prices surged from about $250,000 to nearly $400,000. People rushed here because homes were still affordable, hoping the city would level up like Fresno or Modesto once did. But every dream of rising prices must face reality. By July 2025, home values had already slipped to around $407,000, down 3.2% from a year earlier. More than 26% of listings had to slash prices just to attract buyers. On the surface, things look calm. But underneath, the market is skipping beats. And the reasons are clear. Bakersfield's economic base isn't strong enough to sustain high housing prices. The city is tied to oil and agriculture, two industries most vulnerable to policy shifts and climate change. As California pushes hard toward cutting fossil fuels, over 16,000 jobs in Kern County's oil industry are under threat. Meanwhile, agriculture struggles with drought, soaring costs, and shrinking water supplies. Bakersfield is stepping into headwinds. Unemployment sits stubbornly at 7 or 8%, far higher than the state average. Median household income is only about $65,000, $70,000, meaning that to buy the current median-priced home, families must stretch nearly 6 times their income. With mortgage rates around 7%, the share of income spent on housing has blown past what the middle class can bear. But economics isn't the only obstacle. Bakersfield's climate is brutally extreme. Summers soar above 108 degrees, 42 degrees. Air pollution ranks among the worst in the nation, and Kern County suburbs frequently sit in wildfire risk zones. All this is pushing home insurance premiums sharply higher, especially as State Farm and Allstate have stopped issuing new policies across California. From an investment perspective, Bakersfield was once a hotspot for rental landlords. But that's changing. Home prices have jumped while rents haven't kept pace, dragging yields down. Some small landlords are already pulling out, as financial, legal, and environmental risks climb higher. Bakersfield is no longer the simple, promised land many imagined. Prices may still look cheap, but with low incomes, high unemployment, harsh climate, and a fraying insurance system, you need a clear head before putting money down here. Ask yourself, are you really buying stability in Bakersfield? Or are you just trading cheap for long-term instability? 3. Modesto. The bubble is deflating, but not yet bursting. Modesto is a perfect example of a market that rose too fast and is now self-correcting. From 2018 to 2022, home prices nearly doubled, reaching over $500,000. But by early 2025, the median had dropped to around $440,000, down 3.5% from the peak, and continues to edge lower. About 22.6% of listings have cut prices, showing that buyer confidence is weakening. This isn't a crash, it's a slow retreat, like a tire leaking air. Unlike Bakersfield, Modesto has a more stable urban infrastructure. However, median household income is only about $70,000, pushing the price-to-income ratio to 6.5, far too high for local workers to buy, with mortgage rates stuck around 7%. Supply is plentiful. New developments like Village the Pium and Tivoli are coming online, with sellers competing through discounts and home upgrades. The market is shifting from sellers to buyers, and small investors are pulling back as rental yields lose their shine. Modesto also carries climate risks similar to other Central Valley cities. Summer temperatures of 104 degrees, 38 to 40 degrees C. Air pollution ranking in the nation's top 5, and flood risks during extreme weather. Insurance hasn't hit crisis levels yet, but premiums are rising, gradually eroding affordability. Modesto isn't collapsing, but it's no longer the easy pick it was during 2020-2021. Buyers need to stay sharp. Are you ready to wait 5 to 7 years for prices to rise again? Or should you look elsewhere for markets with better long-term potential? 2. San Bernardino. The dream of cheap homes, the reality of cracks. San Bernardino was once seen as the breathing room option for those priced out of Los Angeles. But when prices here hit around $500,000, the whole story of cheap began to show its flaws. The median household income is only about $49,000, while buyers would need more than 2.5 times that to afford a home. The price-to-income ratio is now 10, an almost unsustainable level. As interest rates climbed, demand from out-of-area buyers, once the lifeline of this market, also shrank. San Bernardino home prices have already slipped 1.6% in 2025, and many experts warn the decline could run deeper. But the problems go beyond numbers. San Bernardino carries heavy social burdens. Violent crime rates 2.2 times the national average, over 25% of residents living below the poverty line, and a failing education system. These factors erode real buyer confidence, even when homes are cheaper than in nearby cities like Rancho Cucamonga. As more young people choose to leave, the population shows no growth. The market is starting to shrink around investors who bought at the peak. If prices keep dropping, risks of bubble bursts, fire sales, and rising foreclosures loom, echoing exactly what happened in the 2008 crash. San Bernardino does have potential. Close to mountains, with plenty of land. But with weak social foundations, high crime risk, and stagnant quality of life, today's prices remain a temporary illusion. If you're a home buyer seeking stability, ask yourself, am I paying for a house or gambling on the future of a city that may never truly rise? 1. Chico, a city. Once burning hot, now cooling down. Chico wasn't on the real estate investment radar until the 2018 Camp Fire disaster turned it into an involuntary destination. When nearby Paradise was destroyed, more than 20,000 evacuees flooded into Chico, sending home prices soaring. But that was only a temporary shock. After a few years, as insurance payouts allowed some to buy homes and others moved away, Chico's market began to cool. Home prices now hover around $455,000, essentially flat, with many listings needing price cuts to sell. The fundamental demand, driven by local incomes, is not strong enough to sustain $500,000 homes. Chico's climate is more pleasant than Southern California, but wildfire risk always hangs overhead. The skies once turned orange, the air filled with ash. That collective memory hasn't faded. Home insurance costs in Chico have surged, with many families forced onto the FAIR plan at rates as high as $7,000 per year. A crushing burden for households earning $55,000 annually. In this context, Chico's market hasn't collapsed, but it has entered a state of long wait. Fewer transactions, cautious buyers, and investors largely uninterested. New land opened up after the fire has added to supply, further capping price recovery. Chico has its own charm. A college town, peaceful, green, and relatively affordable. But for those who run the numbers carefully, it's no longer a safe bet for real estate investment. Unless you plan to stay long-term, enjoy small-town life, and accept both wildfire risks and high insurance costs, you may want to look elsewhere. California's housing market is changing fast. Prices are high, incomes aren't keeping up, and climate and insurance risks are becoming more visible. Cities that once attracted buyers with cheap homes are now showing their weaknesses. Fragile economies, harsh environments, and shrinking real demand. In this context, buyers can't just look at price. The more important question is this a place worth living in long-term, and can I afford to hold on if the market turns? The California dream isn't dead. It's just forcing us to be more clear-eyed. And clarity, that is your strongest weapon as you step into the 2025 market.